Welcome to the Deep Dive. We're here to break down the best research out there and get straight to the actionable knowledge.
Glad to be here.
Today, we're on a bit of a critical mission, I think. We're diving deep into the world of high-risk, high-reward investing.
Yeah, exciting stuff.
Exactly. This is, where you hear about those incredible 1,600% gains, the trade that changes everything, the hunt for the next Amazon or maybe the next GME surge. But the goal today isn't just to chase those highs, it's figuring out how you can pursue those really aggressive, super volatile opportunities without, and this is key, completely wrecking your portfolio in the process.
That's the crucial distinction, isn't it?
Yeah.
It's the system that separates, let's say, intelligent risk-taking from just pure gambling.
Okay.
If you look at, the big Wall Street players versus the average individual investor, their edge isn't usually some secret information pipeline.
Right.
It's fundamentally about better risk assessment and, crucially, better risk management. The source material is pretty clear. Get better at managing the risk, and the higher returns tend to follow.
That feels almost backward, but it makes sense. The path to really big returns isn't just being reckless, it's being calculated. Ruthlessly so, maybe.
Exactly.
Calculated. So let's unpack that system. What are the absolute ground rules? What do we need firmly in place before even thinking about making these aggressive bets?
Okay, ground rule number one is diversification. But with a specific kind of structure, we have to start by acknowledging that the slow, steady way, buying and holding index funds or stable blue chips, that's how real long-term wealth is usually built.
The boring stuff that works.
The boring stuff that really works. Our sources suggest putting nearly half of your whole wealth-building effort into that kind of low-risk, long-haul approach.
And that sets up this critical 80-20 rule for the aggressive side, right? You need a solid launch pad if you're going to shoot for the moon.
That's a great analogy. You can only really afford to risk capital on these hyper-volatile plays if the vast majority of your portfolio is built to withstand a complete wipeout in that small, risky slice.
Okay, so break down the 80-20.
Right. The core idea is keeping 80% of your total investable assets in reliable, low-risk companies. Stuff you plan to hold for a long, long time.
We talking big names.
Yeah. Think companies with strong competitive advantages, wide economic moats, as they say, predictable earnings, consistency. Your massive tech firms like Alphabet, Microsoft, or, as the sources kind of amusingly put it, trash stocks.
Trash stocks, I like that.
Yeah, meaning the super boring but incredibly consistent utility companies, waste management firms like Waste Management itself, WM.
Okay, so unsexy, predictable, that's the ballast. That's the 80% anchor you need.
Absolutely. That stable 80% is the non-negotiable foundation. Because, let's be honest, if you only use the high-risk strategies we're about to get into, like, speculative options or tiny altcoins, the odds are really high. You'd lose a significant chunk of money, maybe even a devastating amount.
Right. Ruin is a real possibility if you skip the foundation.
Definitely. And beyond just the 80-20 split, the single most important tool for actually entering any volatile position is mastering dollar-cost averaging, DCA.
Okay, DCA. I usually think of that as, retirement advice.
Yeah.
Put $100 a month in your 401k forever. But you're saying use it dynamically for aggressive stuff.
Exactly. We're defining DCA here as investing equal, smaller amounts of money into a single volatile asset over regular intervals, maybe weekly, maybe monthly, and you do it regardless of what the price is doing at that moment.
Why is that so critical for volatile things?
Because trying to perfectly time the absolute bottom of something that's swinging wildly, it's basically impossible. If you try to nail a specific price and go all in, you expose yourself to massive event risk. What if some terrible news breaks right after you bought? You're instantly down big.
And this is where that Nikola Motors example, the NKLA story, really hits home.
Absolutely. NKLA was a SPAC, a special purpose acquisition company, basically a shell company that merges with a private one to take it public, inherently volatile.
Right.
So if an investor just dumped all their allocated capital into NKLA shares right when the merger happened, well, they would have faced an 80% loss pretty quickly when the management got hit with fraud charges, essentially lying about their tech.
Ouch. But with DCA.
If that same investor had used DCA, spreading that same investment out over, say, 6 months instead of one big chunk, they would have bought shares at various price points, averaging down their entry costs significantly.
So it cushions the blow.
It cushions the blow, exactly. It smooths out your entry price and prevents that immediate catastrophic news event from completely wiping out your bet on that specific company.
Okay, foundation laid. 80/20 rule, DCA for entries.
Oh.
Now let's pivot. Let's talk digital volatility, cryptocurrencies. When the sources talk high risk, high reward, crypto's got to be right near the top.
Oh, absolutely. It's high on the risk pyramid. We're talking about a sector worth, what, over $2 trillion globally now? It's huge.
And within crypto itself, the base layer, the original, is Bitcoin, BTC. Now, for a lot of people, Bitcoin is purely speculative. Just number go up. But the sources really emphasize that its staying power, that first mover advantage, actually comes from its original utility.
Yeah, and that utility is often forgotten. It's designed as this peer-to-peer cash system, censorship resistant, outside the control of banks or governments.
And that has real-world implications we might not think about day to day.
Totally. Like the example given is transferring, say, $50,000 to someone in France. Instantly, securely, without needing bank wires that cost a lot and can take days.
Or even more critically, during crises.
Right. We've seen it used to try and preserve buying power when a country's currency collapses, like in Venezuela with hyperinflation, or maybe even more powerfully as an asset you can take with you if you have to flee an authoritarian regime. All you need is to remember a private key or a seed phrase, much safer and easier than carrying stacks of cash or bars of gold across a border.
So that core utility gives it a baseline value proposition, but the price you pay for potentially higher returns is, well, insane volatility.
Exactly. Volatility is the price of admission. Let's revisit that classic HO dealing story from the source material. It really illustrates the point.
Yeah, this one's great. It shows why you need conviction, not panic. The source talks about putting $500 into Bitcoin back in summer 2017.
Okay.
Initially, that $500 exploded, like 500% gain, turning into $3,000 as Bitcoin rocketed towards its peak around, what, $19,650?
Yeah, big run up.
But then the music stopped.
Then came the crypto winter. Brutal. By the end of 2018, Bitcoin had crashed something like 81% from that peak.
81%. That's devastating if you bought near the top.
Totally demoralizing. And that's where HO dealing, holding on for dear life, becomes absolutely essential. Because when the news goes quiet, prices are in the gutter, you need something internal, some metrics to convince you to stick with it.
So what kind of metrics help you hold on during a massive crash like that? It can't just be blind faith.
No, definitely not. One key indicator the source material mentions is something called net unrealized profit and loss, or NUPL.
NUPL. Okay, what's that telling us?
It's basically a gauge of overall market sentiment, derived from the blockchain data itself. It compares the current market cap to the price where coins last moved. When NUPL gets really low, it means most long-term holders are actually sitting on paper losses.
Ah, so it signals extreme fear, maximum pessimism.
Exactly. And historically, those periods of extreme fear where NUPL is in the capitulation zone have been the best times to either buy more or at least just hold tight. Statistically, that's near the cycle lows.
And that conviction, that ability to hold through the fear, was tested again massively during the March 2020 COVID crash.
Oh, yeah. Global panic.
Yeah.
Bitcoin dropped over 50% in just a couple of days. Everything was selling off.
But if you stuck to that long-term thesis, maybe watch that NUPL indicator.
You were rewarded. Bitcoin finished that same year, 2020, hitting a new all-time high around $42,000. It's a stark reminder. The volatility is just part of the deal if you want exposure to this asset class long-term.
Okay, so Bitcoin is high risk. Then altcoins, basically everything else in crypto, that's like extreme risk territory.
That's a good way to put it. Extreme risk, extreme reward potential. These are the tokens where you might see a 300% jump in a week. But the flip side is they can go to zero. Absolute ruin is possible.
And the classic cautionary tale here has to be Ripple and its XRP token. The initial idea sounded so powerful.
It did. Ripple Labs wanted to replace the old, clunky SWIFT system for international bank transfers. SWIFT takes 3 to 5 days, has fees.
Right.
Ripple proposed using XRP for instant, cheap, large-scale global transactions. The utility thesis, revolutionizing liquidity, was incredibly compelling.
And that narrative fueled a massive initial pump.
Huge. The source mentions a $500 investment in September 2017 ballooning to $10,000 by early 2018. Insane gains. But by September 2018, that $10,000 was back down to $1,000. And the really crucial lesson wasn't just the price volatility, it was the lurking regulatory risk.
Okay, what was the specific regulatory issue that killed XRP's momentum, at least in the US?
It boiled down to centralization. Unlike Bitcoin, Ripple Labs, the company, used a more centralized way to validate transactions. And critically, the company itself created and then sold over $1 billion worth of XRP tokens to fund its operations.
Ah, so the SEC saw that.
The SEC looked at a company creating tokens and selling them to the public to raise money and said, wait a minute, that looks like an unregistered security offering, subject to all the same rules as stocks.
And that's the key legal difference compared to something like Ethereum.
Exactly. Ethereum was designed from the start to be decentralized. There wasn't one single company issuing ETH and profiting directly from the sales in the same way. That's why ETH generally avoided the security label.
And the fallout for XRP was severe.
Devastating in the U.S. market. It got delisted from major exchanges like Coinbase in late 2020. Liquidity dried up. It proved that even a great utility idea means nothing if the regulatory foundation isn't sound.
And the stats on altcoins generally are pretty sobering after that cycle.
Brutal. A study by Masari found that something like 83% of the altcoins that hit their all-time highs back in January 2018 were still trading more than 90% below those highs during the next bull run in 2020-2021.
Wow, so most of them never recovered. A huge graveyard.
It's a huge graveyard. Extreme caution is needed with altcoins.
Which brings us to the biggest altcoin, Ethereum, ETH, often called one computer for the entire planet. Its market cap is massive, sometimes bigger than huge traditional companies like IBM or McDonald's.
Yeah, Ethereum's role is different. It aims to be a decentralized operating system, and its main superpower is enabling smart contracts.
Smart contracts. Okay, I need to understand this. Why are they revolutionary?
You have to grasp that they are self-executing agreements. The terms, the if-then conditions, are written directly into the code on the blockchain.
So they cut out the middleman.
Completely. They remove the need for a trusted third party like a bank, a lawyer, or an escrow service to enforce an agreement. The code enforces it automatically.
Okay, let's use that super dApp analogy from the source. That sounds like a good way to visualize it, like a decentralized Uber.
Exactly. Imagine an app called Super. A user requests a ride. The system finds a nearby driver. Here's the key. The payment isn't held by Super, the company. The funds are immediately locked into a cryptographic contract on the Ethereum blockchain. Everyone can see it.
Okay, the funds are locked. What releases them?
The code. The contract's terms are baked in. For example, it might say, if the rider's phone GPS matches the destination airport's GPS coordinates for 1 minute, then automatically release $6 amount of crypto from this contract to the driver's digital wallet address.
And it just happened.
Instantly. Automatically. No appeals, no waiting for Uber to process the payment. The contract executes itself based on the agreed-upon data inputs. Super, the app, is just the interface connecting rider and driver. It doesn't touch the money or act as the trusted intermediary.
So it eliminates Uber's 25% cut.
And the need to trust Uber or the driver or the rider about payment. The trust is in the code. That's the fundamental power of Ethereum, enabling trustless interactions and applications.
Okay, so when we're looking at ETH as a high-risk investment, it's not just about the network effect. We need to look deeper at the tech and the token itself.
Absolutely. 3 key things to analyze. First, intrinsic value. The ETH token itself has value because it's the gas needed to run things on the network. You must pay fees in ETH to execute smart contracts or use dApps.
Okay, it fuels the system.
Second, and this is super important, tokenomics. You have to understand the supply and demand dynamics. Specifically, you want deflationary assets, not inflationary ones.
Right. Why is deflationary versus inflationary so critical here, and how did Ethereum become deflationary?
Okay, an inflationary token, like, say, Dogecoin, is constantly creating new supply. 10,000 new Dogecoins mined every minute forever. That dilutes the value of every existing coin over time. Supply goes up infinitely. A deflationary asset, like Bitcoin, has a fixed capped supply, only 21 million BTC ever. Ethereum used to be inflationary, but a major upgrade called EIP 1559 introduced a deflationary mechanism.
How does that work?
Now, part of the transaction fee you pay to use the network, the base fee, doesn't go to the validators. It gets burned.
Burned, meaning destroyed.
Permanently removed from circulation. Deleted. So if network activity is high enough, more ETH gets burned through these fees than is newly created through validation rewards.
So high usage actually shrinks the total supply of ETH over time.
Exactly. That's incredibly bullish long term. You're potentially investing in an asset where the supply actively decreases as its utility and usage increase. That's powerful tokenomics.
Okay, intrinsic value as gas, deflationary tokenomics. What's the third factor?
Third is adoption. Simple enough. Are major companies, institutions, developers actually building on Ethereum? Are they using it?
So look for real-world use cases.
Yeah. Seeing names like JP Chase, Amazon Web Services, Microsoft exploring or building enterprise solutions using Ethereum. Those are strong signals of long-term validation and adoption.
And the strategy for ETH, given its status but still high risk?
Still follows the ground rules. Use DCA to build your position over maybe 2 or 3 months, smooth out that entry, and then prepare to HODL for long term based on that utility, tokenomics, and adoption thesis.
All right, let's shift gears again. We've covered the sort of long-term, utility-focused volatility of crypto. Now let's get into the shorter-term, often sentiment-driven stuff, these special situations that capitalize on market hype, maybe panic, specific catalysts.
Yeah, these are much more tactical plays, and we have to start with the one that blew up the internet a few years back,
Yeah.
the short squeeze, GameStop, GME being the poster child.
Right. So first, just quickly, what exactly is shorting again?
Okay, shorting is when you borrow shares of a stock from your broker, sell them on the open market, hoping the price goes down. If it does, you buy the shares back cheaper later, return them to the broker, and pocket the difference as profit.
But the risk.
The risk is theoretically infinite. If the stock price goes up instead of down, you still have to buy those shares back eventually to return them. If it keeps going up, your losses can just keep piling up indefinitely.
And a short squeeze is basically the short seller's worst nightmare scenario. How does that mechanic work?
It's a feedback loop. When a heavily shorted stock starts to rise sharply, maybe due to unexpected good news or buying pressure, those short sellers start facing big paper losses.
Margin calls.
Exactly. They might get margin calls, forcing them to close their position by buying back the shares immediately, regardless of price, just to stop the bleeding.
And that forced buying.
That forced buying creates even more demand, pushing the price up even faster, which then forces more short sellers to cover, creating more demand. It's this massive buying frenzy, an exponential price explosion, a squeeze.
GME was just incredible to watch. It felt like a David versus Goliath story playing out in real time.
It really did. It was this perfect convergence of technical factors meeting online sentiment. You had retail investors, particularly on forums like Reddit's Wall Street Bets, galvanized by analysis from people like Keith Gill.
Roaring Kitty.
Right. They identified that GameStop was incredibly heavily shorted by big hedge funds. They started buying up shares and call options, specifically targeting those shorts.
It worked.
Spectacularly. It forced huge funds, most famously Melvin Capital, into a corner. They had to buy back GME shares at insanely inflated prices just to cover their massive short positions. Melvin reportedly lost billions in January 2020 alone. GME stocks surged, what, 1,600% in about 2 weeks? Just wild.
So the million-dollar question, how does an individual investor spot the next potential GME? There must be specific signals, right? This probably ties back to that information asymmetry idea.
It absolutely does. And again, the sweet spot often lies where the big institutions aren't looking as closely, or maybe can't even play the small cap space.
Why small caps specifically?
Because many large institutional funds have rules preventing them from investing in companies below a certain market capitalization, maybe $1 or $2 billion. This creates an inefficiency. A really diligent retail investor doing the homework might spot the technical setup for a squeeze in a smaller company before the big money even notices or is allowed to jump in.
Okay, so small market cap is filter number one. What are the key technical flags for a potential squeeze?
3 main things to look for. First, a very high short interest as a percentage of the float.
Okay, unpack float.
Right. The float isn't all the shares outstanding. It's the number of shares actually available for public trading. You exclude shares held tightly by insiders, governments, restricted stock. A high short interest relative to that number, say over 20%, means a big chunk of the readily tradable shares are owed back by shorts.
Okay, high short interest percent of float. Second is a small market cap. You said ideally under $2 billion because it's easier for buying pressure to actually move the needle. And
Third, and this is critical, is days to cover.
Days to cover. How's that calculated?
You take the total number of shares shorted and you divide it by the stock's average daily trading volume.
Okay.
A high number, let's say over 10 days, means that even if all the shorts wanted to cover, based on typical trading volume, it would take them more than 2 full trading weeks to buy back all the shares they owe.
So if a squeeze starts, they can't all get out quickly. The buying pressure is sustained.
Exactly. It traps them.
Yeah.
That sustained pressure is what can really fuel those explosive moves. High short interest, small cap, high days to cover. That's the trifecta you're looking for.
And the trading strategy here has to be incredibly disciplined, right? This isn't buy and hold.
Absolutely not. This is tactical, almost like a commando raid.
Yeah.
Keep the position size tiny,
Yeah.
less than 1% of your total portfolio. Treat it like a lottery ticket, but one where you've calculated the odds are maybe slightly better.
And the exit. How do you know when to sell?
This is crucial. You sell when the daily trading volume peaks and starts to noticeably decline, even if the price is still high or even ticking up slightly. That drop in volume is your signal that the buying frenzy is exhausting itself. The shorts who needed to cover have covered, the FOMO buyers are drying up. Get out then, because the crash can be just as fast and brutal as the rise. Don't get greedy.
Okay. That naturally leads us to meme stocks. AMC is the classic example here. Is this just a variation on the short squeeze theme or something different?
It's related, but maybe even more purely sentiment-driven. Meme stocks are often fueled almost entirely by social media hype. Coordination on platforms like Wall Street Bets, often latching onto nostalgia or a simple narrative rather than deep financial analysis.
Right, AMC, struggling movie theater chain, business model challenged by streaming even before COVID. Why them?
Well, it shared some characteristics with GME. It had that nostalgia factor, people remembered going to the movies. And importantly, it also had high short interest, so it fit the profile for the Wall Street Bets crowd looking for the next GME. The narrative took hold.
So identifying these is less about fundamentals and more about tracking the buzz.
Pretty much. The sources suggest actually monitoring things like website crawlers, YOLO stocks, was mentioned, that track how often stock tickers are mentioned on Wall Street Bets and other forums.
So you're literally tracking the hype meter.
You're tracking the hype meter, yeah. Combine that with the technicals we just discussed. Look for high short interest, again, maybe over 20% of the float. And also look for unusual activity in the options market, which might signal a potential gamma squeeze.
Gamma squeeze. Okay, that sounds related but different. How does a gamma squeeze work, and how is it different from a standard short squeeze?
Good question. A gamma squeeze is specifically driven by options market mechanics, not just short sellers covering stock. It starts when lots of traders, often retail, buy huge numbers of call options, usually ones that are out of the money, meaning the stock price is currently below the option strike price.
They're betting the price will surge past the strike price.
Exactly. Now, the people on the other side of that trade, the market makers who sold those call options, they face potentially huge losses if the stock price does blow past the strike price before expiration. They don't want that exposure.
So they hedge.
They have to hedge their risk. And the way they hedge selling calls is by buying the underlying stock itself. As more and more calls are bought, and as the stock price gets closer to those strike prices, the market makers are forced to buy more and more shares to remain hedged.
Ah, so their hedging activity itself drives the stock price up.
Precisely. It becomes a self-fulfilling prophecy. Retail buys calls. Market makers buy stock to hedge. Stock price goes up. More calls become in the money or closer to it. Market makers forced to buy even more stock to hedge their increased risk. Price explodes upwards. That's the gamma squeeze, fueled by options activity forcing stock purchases.
Wow. Okay. And the trading discipline for a meme stock gamma squeeze play. Still tiny allocation.
Identical. Absolutely non-negotiable. No more than 1% of your capital. You wait for the volume surge, you wait for the squeeze, whether it's short or gamma or both, to really kick in, and you sell into that strength immediately. Take the profit and run. Never fall in love with a meme stock.
Okay, now for what sounds like the absolute riskiest play of all. Bankrupt stocks. Buying shares in companies that are actually in Chapter 11 bankruptcy proceedings. Historically, isn't it true that stockholders get wiped out in bankruptcy?
Very often, yes. In a traditional bankruptcy, bondholders and other creditors get paid first from any remaining assets. Stockholders are dead last in line, and usually there's nothing left for them. So yes, the baseline risk here is a 100% loss. The stock goes to zero.
So why would anyone ever do this?
Because sometimes, counterintuitively, there's opportunity. There's actually a JP Morgan study cited that found historically stocks of companies emerging from bankruptcy often significantly outperform the S&P 500 in their first year out because they often emerge much healthier. They shed massive amounts of debt during the Chapter 11 process. Think about companies like Kmart, Six Flags. They went through bankruptcy and came out leaner, meaner, and eventually thrived because their underlying business or brand still had value once the crushing debt was gone.
And the pandemic provided a really dramatic recent example with Hertz, the car rental company.
Perfect case study. Hertz was already struggling before COVID hit. Pandemic lockdowns crushed travel. They filed for bankruptcy in May 2020. Stock collapsed over 80%. Looked like game over for shareholders.
But then something unexpected happened.
Totally unexpected. Hertz's main asset wasn't really its brand or booking system. It was its massive fleet of used cars. By early 2021, thanks to vaccine rollouts boosting travel demand and, crucially, pandemic-related supply chain issues crippling new car production.
Used car prices went nuts.
Absolutely nuts.
Yeah.
Surged like 25% or more. Suddenly, Hertz's biggest asset, its car fleet, was worth way, way more than anyone had anticipated when they filed for bankruptcy. The value on their balance sheet exploded upwards.
And that attracted buyers for the company itself.
Exactly. It triggered a bidding war to take Hertz out of bankruptcy. The winning deal, led by Knighthead Capital, was structured in a way that was incredibly rare. It included a cash and warrants distribution worth around $8 per share for the existing shareholders.
Shareholders who had bought the stock when it was trading for pennies, like $0.30 after the bankruptcy filing.
Yeah. It was an unbelievable turnaround. A classic case where extreme fear completely mispriced the underlying assets due to an unforeseen catalyst, the used car price surge.
Okay, so if the risk is total loss, but the potential reward is astronomical, the screening process here has to be incredibly selective. What are you looking for?
You absolutely cannot just buy any bankrupt stock. You have to focus only on companies where there's a strong reason to believe there's significant underlying value that might survive the bankruptcy. Usually this means a strong, enduring brand name that people recognize and trust, like General Motors, Marvel, Hertz, or maybe a company with unique assets or some kind of economic necessity.
And you need to follow the proceedings closely.
Very closely. You need to assess. Is a bidding war likely? Are creditors potentially agreeing to take equity in the reorganized company instead of just demanding cash, which is often a good sign for existing shareholders? It requires deep dive research into the specifics of the bankruptcy case.
And the allocation size, given the 100% loss risk.
Still needs to be strictly controlled. Maybe slightly more than a meme stock, but not much. Say no more than 3% to 5% of the portfolio maximum. Because if you're wrong, it's gone.
And the exit strategy. If the company does emerge from Chapter 11 and your bet pays off,
You generally want to take profits very quickly, right around the time the company officially emerges. The stock price action immediately post-bankruptcy can be incredibly volatile. Your goal with this high-risk play wasn't necessarily to hold the new company long-term. It was to capture that specific re-rating event, that initial pop as it exits Chapter 11. Lock in the gain from the turnaround. Okay, now we need to venture into what are arguably the most powerful and definitely the most easily misused tools in the high-risk toolkit. Derivatives, specifically options.
Ah, options. Yeah, there's that great quote from Victor Sparandea's mentor, right? There are old traders and there are bold traders, but there are very few old, bold traders.
That captures it perfectly. Options offer incredible leverage, but that leverage cuts both ways hard. They are probably the #1 way amateur traders blow up their accounts by being too bold too fast.
So let's break it down. The core risk with options comes from that time decay, right? An option is just a contract giving you the right, but not the obligation, to either buy, that's a call option, or sell, a put option, 100 shares of a stock at a set price, the strike price, on or before a specific date, the expiration date.
Exactly. And the killer is, most options contracts estimates range from 70% to 80% expire worthless. They reach their expiration date, and the stock price hasn't moved enough in the right direction. Poof, the money you paid for the option is gone.
So to make money buying options purely for speculation, you have to be right about multiple things.
You need to be right on the direction. Will the stock go up or down? The magnitude, will it move enough to overcome the option premium paid? And the timing, will it happen before the option expires? Getting all three right consistently is incredibly difficult.
And that timing element is where many people get tripped up. The Pfizer vaccine example from the source illustrates this perfectly.
Yeah, Ivan, the trader in the example, bought Pfizer call options, betting the stock would surge past a 45-hour strike price when the positive vaccine news hit during the pandemic.
His thesis was right. The vaccine was huge news.
The thesis was spot on, but his timing was off. The market is a discounting mechanism. It looks ahead. By the time the official good news about the vaccine was announced, the market had largely already priced it in. Pfizer stock didn't surge dramatically after the announcement.
So the calls didn't get valuable enough before they expired.
Right. They expired worthless, even though his core idea about the vaccine's importance was correct. For speculative option buying to work, you generally need to identify a catalyst, maybe an earnings surprise, a regulatory decision, a Fed pivot that you believe the market hasn't fully anticipated yet.
Okay, contrast that failure with a really strategic win using put options, the example of shorting Tesla via its convertible bonds back in February 2019. This sounds much more complex.
It was definitely a more sophisticated deep dive play. This is where that asymmetrical insight really comes into play. Tesla had this huge debt payment looming. They owed $920 million if their stock didn't average above roughly $360 by March 1st. linked to some convertible bonds.
Okay, a big ticking clock.
A massive one. The key insight the trader had was realizing that the put options on Tesla stock seemed way too cheap relative to the potential impact of that massive upcoming cash payment.
Why would the puts be underpriced if this huge payment was known?
Because the market, or at least the options market pricing, seemed focused on Tesla's usual volatility and future prospects, but maybe wasn't fully appreciating the immediate and severe hit to Tesla's cash balance.
Yeah.
If they were forced to make that $920 million payment right then.
Especially given the context at the time.
Exactly. Remember, Tesla is going through a lot of turmoil, then executive departures, Elon Musk having issues with the SEC again. Making $920 million payment would consume something like 30% of their available cash at that moment. It was a potentially crippling blow.
So the options market was pricing volatility, but maybe not pricing the specific binary risk of that huge cash outflow.
That was the thesis. The traders saw this disconnect. The puts seemed too cheap given this very specific date-driven financial risk. So they bought put options, betting the stock would fall after the deadline passed, and Tesla inevitably had to write that massive check.
And it worked.
It worked beautifully. The deadline passed, Tesla confirmed they'd make the cash payment, and the stock sold off as the market digested the hit to their cash reserves. The put options exploded in value, a brilliant trade based on deep financial analysis, not just guessing direction.
Okay, so for anyone attempting speculative option buying, the rules need to be ironclad.
Absolutely ironclad. First, allocation, tiny. No more than 1% of your investable assets per trade. Seriously, treat it like venture capital. Second, and this is critical for execution, always use limit orders, never market orders.
Why limit orders specifically for options?
Because options prices can move incredibly fast, and the gap between the buying price, ask, and selling price, bid, the spread, can be very wide, especially for less common options. A market order just says, buy me 10 contracts at whatever the current price is. You could get filled at a terrible price, way higher than you expected.
Whereas a limit order.
A limit order says, buy me 10 contracts, but only if you can fill me at $6 price or lower. It guarantees your entry price or prevents the trade from happening if the price runs away from you. Absolutely essential for managing costs in volatile options.
Okay, let's shift from pure speculation to using options in a more conservative, maybe income-generating way, selling cash-secured puts.
Right. This is a strategy favored by many more calculated long-term investors because it actually puts the statistical odds slightly in your favor.
How so?
When you sell a cash-secured put, you are selling someone else the right to sell you 100 shares of a stock at a specific strike price, which is typically below the current stock price. In exchange for taking on that obligation, you receive cash up front, the option premium.
Okay, you get paid immediately.
You get paid immediately. Now, remember, we said most options expire worthless. That includes puts. If the stock price stays above your strike price by expiration, the put option expires worthless. The buyer doesn't exercise their right to sell you the shares.
And you just keep the premium you collected.
You just keep the premium free and clear. That's your profit. That happens maybe 30% to 50% of the time statistically, depending on the option. So you have a decent chance of just collecting income.
But what if the stock price does fall below your strike price before expiration? Then you have to buy the shares, right?
Yes. If the stock price is below the strike at expiration, the option buyer will likely exercise their right, and you are obligated to buy 100 shares at that strike price. But here's the key. You wanted to potentially own the stock anyway, and you're getting it at a discount.
How is it a discount?
Your effective purchase price isn't just the strike price. It's the strike price minus the premium you already received up front when you sold the put. So you essentially bought the shares for less than the strike price, which was already below where the stock was trading when you initiated the trade.
So win-win. Either you keep the premium as income or you buy a stock you wanted anyway at a lower effective price.
That's the ideal scenario. Which leads to the absolute golden rule of selling cash-secured puts. And you cannot break this rule. Only sell puts on stocks you genuinely want to own for the long term at that strike price.
Don't just chase high premiums on junk stocks.
Never. That's the classic mistake. Someone sees a huge premium available for selling puts on some terrible failing company and thinks free money. But then the stock collapses, they get assigned the shares, and now they're stuck holding a bag of garbage they never actually wanted, potentially at a huge loss. Only sell puts on quality companies you'd be happy to acquire at that lower price.
And the perfect storm for this strategy, ironically, was during that March 2020 COVID crash.
Absolutely perfect setup, because volatility went through the roof. The VIX index hit its highest levels ever.
Okay, quick reminder. The VIX. What is it, and why does a high VIX matter so much for option sellers?
The VIX is the market's fear gauge. It measures the implied volatility that the options market expects over the next 30 days. When the VIX is super high, like it was in March 2020, it means the market is pricing in massive, wild price swings.
And that fear jacks up option prices.
Dramatically. The premiums on options, both calls and puts, become incredibly expensive because the perceived risk is so high. So for an option seller, a high VIX means you can collect much, much more income premium for taking on the obligation.
So back to March 2020, Boeing stock gets crushed, down 74% to like $89. Insane fear. But the VIX is sky high.
Exactly. Now, if you did your homework, you'd recognize Boeing has a wide economic moat, basically only one major competitor globally, Airbus. It's deeply tied to U.S. manufacturing and defense. Bankruptcy, while possible, seemed highly unlikely due to implicit government support.
A strategically important company.
Very. So selling a cash-secured put with, say, a $90 strike price on Boeing at that moment became a really high-probability, high-reward trade. The premium you collected would have been massive because the VIX was so high, reflecting the market's panic.
And your worst-case scenario?
Your worst case was being forced to buy shares in a globally dominant, government-backed aerospace giant at an effective price below $90 after it had already fallen 74%. That's a risk many calculated investors were willing to take for that huge upfront premium.
Makes sense. What kind of allocation is reasonable for a cash-secured put strategy? It feels less speculative.
It is less speculative. If done correctly, you could allocate maybe up to 10% of your portfolio to managing cash-secured put positions, especially if you're generating income. And remember, the best time to sell puts is often when the VIX is high, when fear is peaking. You get paid the most to be greedy when others are fearful, as Buffett would say.
Okay, one more options flavor. EAAAAPS. Long-term equity anticipation securities. Sounds fancy, but what are they really?
They're actually just regular call options, but with expiration dates much further out in the future, typically longer than 7 months, often 1 or even 2 years out.
And why use such long-dated options? What's the purpose?
Capital efficiency for high-conviction, long-term bets. Let's say you strongly believe in a major secular growth trend, like e-commerce or cloud computing, and you've identified a leading company in that space that you think will perform very well over the next couple of years.
Okay.
Buying the stock outright might tie up a lot of capital. Buying a leap call option on that same stock allows you to control 100 shares worth of exposure for a fraction of the cost of buying the shares themselves.
The Etsy example in the source makes this clear. Andy buys Leap S, Jane buys the stock.
Right. Let's say Etsy stock is $100. Jane buys 100 shares for $10,000. Andy buys a 2-year LEPEC call option with maybe an $80 strike price for, let's say, $30 per share. $3,000 total cost.
Okay, much less capital upfront for Andy.
Much less. Now, fast forward a year, and Etsy stock has surged 50% to $150. Jane's $10,000 investment is now worth $15,000, 50% return. Pretty good.
What about Andy's?
Andy's leap option, giving him the right to buy at $80 when the stock is $150, is now worth at least the intrinsic value of $70 per share. $150, $80. Plus, it still has a year left until expiration, so it has time value too. Let's say the E is now trading at $75. His $3,000 investment is now worth $7,500.
So Jane made $5,000 on $10,000, 50% return. Andy made $4,500 on only $3,000.
There's a 150% return, higher percentage gain on significantly less capital deployed. That's the power of leaps for long-term conviction, plays leverage and capital efficiency. It frees up the rest of Andy's capital for that stable 80% base.
But leaps are still options. They can still expire worthless if you're wrong about the long-term direction or timing. How do you manage that risk?
Strict risk management is still paramount. First, allocation. Keep leap positions relatively small, maybe no more than 3% of your total assets per position. Second, and this is crucial for leaps, use a hard stop loss.
A stop loss on an option, how's that work?
You set a mental or actual stop loss based on the value of the LP contract itself. The source recommends a hard 35% stop loss. If the value of your LP option drops by 35% from your purchase price, you sell it, period.
Why 35%?
It's somewhat arbitrary, but the idea is to cut your losses relatively early. Because leaps are long dated, if the stock moves against you significantly early on, the time decay combined with the price move can erode the option's value quickly. A 35% stop loss aims to preserve a decent chunk of your initial capital if your thesis proves wrong early, preventing a 100% loss if you just held it to expiration hoping for a turnaround.
And this was used effectively on Microsoft post-COVID.
Yeah, the example cited was buying Microsoft Leafs, betting on the continued dominance of their cloud platform, Azure, and remote work tools, Teams, even when some analysts were maybe a bit bearish initially. The Leafs provided leveraged exposure to that multi-year growth trend, and the stop loss provided downside protection. Hashtag via outro and final provocation.
Wow, okay. We've covered a huge amount of ground today. From crypto's long-term volatility to short-term squeezes and meme stocks, all the way to the complexities of options like puts and LEPS.
Yeah, it's a tour through the higher risk end of the investment spectrum, synthesizing, the structural risks of something like crypto with the tactical, sentiment-driven risks of squeezes, and then the advanced leverage risks of derivatives.
And the common thread, the absolute constant through all of it, seems to be that disciplined risk management. It's not optional, it's the core requirement.
Absolutely. That deep dive really reinforces those essential rules for you, the listener. You need that stable 80% foundation. You need to use tools like DCA strategically, especially when entering volatile positions. And you need incredibly careful selection and sizing when dealing with special situations or advanced tools like options.
So the key takeaways really boil down to do your homework, manage your position size obsessively, and understand the specific catalyst or thesis for why you're taking the risk.
Exactly. The due diligence is non-negotiable for every single strategy. Are you vetting the tokenomics of an altcoin? Are you confirming the technical setup for a squeeze? Are you analyzing the balance sheet and debt structure of a bankrupt company? You must quantify and understand the risk you're taking before you take it.
And keep those allocations tiny for the really speculative stuff. We kept hearing 1%, maybe 3-5% limits for most of these strategies. Focus on the catalyst, the trend, not just the hype.
Right, which brings us back to that idea we touched on earlier, information asymmetry, and where the best opportunities might actually lie for an individual investor.
Yeah, the idea that while the big institutions dominate, maybe the individual has an edge somewhere.
Potentially. The argument is that the individual can be nimbler. They can explore corners of the market the big funds ignore or simply can't invest in due to size constraints.
And where specifically might that edge be found?
The sources strongly suggest looking at small cap stocks. We're talking companies with market caps roughly between $100 million and maybe $1 or $2 billion.
What?
Because this segment is often under-researched by Wall Street. A positive earnings surprise, a new contract, successful R&D news like that might not be instantly priced in like it would be for Apple or Microsoft. Large funds might not even be covering the stock yet.
So there's a potential information lag an individual can exploit.
Exactly. If you're willing to do the deep, independent research, really understand the company, its niche, its management, its financials, you might uncover value or a potential catalyst before it hits the mainstream radar and before the big institutional money can pile in.
It requires going against the grain sometimes, doing work others aren't, like that David Tepper example.
Perfect example. Buying distressed bank stocks in early 2009, right after the government announced the Financial Stability Plan. The popular narrative then was total fear maybe the banks would be nationalized, wiped out. Tepper did the deep dive, read the fine print of the plan, and made a massive contrarian bet that the government support would actually backstop them. He went against the consensus based on his own detailed work.
So the final thought is, the path to high rewards often lies in that deep independent analysis, finding value or catalyst where the crowd isn't looking, and then having the discipline to manage the risk on that conviction.
That's the essence of it. Develop your unique thesis, back it with calculated limited risk. That's how you leverage the deep dive for potentially outsized returns.
Fantastic insights. Thanks for diving deep with us today. We'll see you next time on The Deep Dive.